Hello everyone, I'm Dave Keller here at StockCharts.com. Welcome to this edition of Behind the Charts. It's our chance to get inside the head of successful investors, traders, educators, and see how they're wired, how they make decisions. Today, we're sitting down with Al Brooks. It's actually Dr. Al Brooks. Al got his start as an eye surgeon and started day trading on the side, eventually focused 100% of his time and rotated from practicing medicine to focusing on the markets. He started day trading in 1987, so talk about a tough start to your day trading career. So we talked a lot about those formative experiences, early challenging experiences, how they helped make him a better trader, a better investor over time. What I loved about my conversation with Al Brooks was he talked about having a particular approach for particular charts. A lot of times I find with technical analysis with charts, people have a very homogeneous perspective. You have one set of tools and you apply that to everything. Al made some really good points about the importance of tailoring your approach to the particular asset, the particular time frame that you're focusing on, which I thought was actually really interesting. Most importantly, one of the best takeaways with Al was focusing not just on risk and reward on a particular trade, but also the probabilities. How probable are certain outcomes? That should be part of your thinking as well. So some great thinking about how to approach the experience of the process of investing with Dr. Al Brooks from the Brooks Trading course. Here we go. Hey everyone, we're here at the Money Show in Orlando, joined by Al Brooks. Al is with Brooks Trading course. Good to be with you, Al. Thanks for sitting down with us.
Appreciate it. Thank you, Dave.
So you also traveled quite a ways, like we did, coming from the Northwest. You come from Northern California to join us, so thanks for making the trip. For those that don't know you and your work with Brooks Trading course, can you just give us your background? How did you get to this point?
Well, years ago, I was an eye surgeon, practicing in LA. Mm-hmm. And all my time when I was at the University of Chicago studying medicine, I felt like I really should be downtown at the Board of Trade or the Merrick. And then in 1989, I had a daughter. Mm-hmm. And the next year, 15 months later, I had identical twin daughters.
Oh, wow.
So I had 3 daughters under the age of 15 months. And I thought, wow, it'd be really great if I could stay home and raise my kids, or at least spend more time at home.
Sure.
Yeah, and I used that as a reason to sell my practice and start day trading. I actually started day trading in '87, mm-hmm. But when my girls were born, I became a full-time day trader.
Got it. And then can you talk about how did you develop your process? Where did you learn how to trade? Was there a mentor that you linked up with, or were you self-taught? How did you sort of learn the craft or learn your toolkit?
I think it's pretty interesting. Yeah. Back in the 80s, mm-hmm. there was much less government control over people marketing, education, and there were a lot of really, really corrupt people out there.
Right.
And at the time, I didn't know. You know, when I was in medical school, I just assumed that you read, you follow people who are successful, you try to copy what they're doing, and you learn the craft.
Right.
And I tried to apply that with trading, and I was losing money. And I ended up losing money for about 10 years.
Wow.
Which is horrible.
That hurts.
You get 3 kids. And I decided that all this stuff that I'm reading, it sounds good, but it's not successful.
Got it.
So I decided that if I just look at a chart and I can see that it's working its way higher, I want to buy.
Right.
Okay. And I decided I'm just going to look for patterns. And I took everything off the chart and I just looked at bars.
Yeah.
And I tried to look for repeatable patterns. Price action. Price action is you're looking at, you're looking at the movement of prices, mm-hmm. trying to get an idea of what will happen going forward.
Sure.
Okay. And I started noticing recurring patterns.
Got it.
And I started trading the recurring patterns, and I started making money. And for the past now over 30 years, I've watched pretty much every tick in the stock market for every day for 30 plus years.
Right.
And I know a lot of patterns. I know a lot of tendencies.
You've seen a couple. Uh-huh.
Yeah, I know a lot of tendencies.
Okay.
And for example, on the E-mini, if you just look at the day session, mm-hmm. there are 81 bars in the day.
Okay.
On an average day, I see probably about 40 reasonable setups, 40 tradable setups.
Okay.
Okay. And there's that much information on a 5-minute chart.
Right.
It's an incredible amount of information.
Absolutely. So interesting. So you mentioned, charts, which is music to my ears, right? Being at StockCharts.com. Can you talk just a little bit more about the technical orientation? What specifically, what's the technical component to what you do? Any particular charts that your go-to chart? Any particular indicators that you use? How would you describe that?
Well, if you watch television and you see experts on television talk about charts, they don't say, "Oh, this is gold, and therefore I'm going to trade it the way I trade gold charts." And they don't. Right. And then they look at a bond chart. They don't say, "Oh, this is bonds. I'm going to trade it like a bond chart." They trade all charts the same.
Right.
And sometimes they'll show a daily chart. Other times they'll show a monthly chart, and they won't look at the daily chart and say, "Oh, it's a daily chart. I got to trade that this way, and I trade monthly charts that way."
Sure.
I view price action and charts as simply a reflection of rational human behavior.
Okay.
And it's true on any time frame, whether you're trading on a chart where every bar is 1 second or a chart where every bar is 1 year.
Yeah.
It's all based upon rational human behavior.
Right.
And the result is going to be relatively predictable patterns. So I trade all markets and all time frames the same. And so yes, I obviously look at charts.
Right.
I don't look at indicators other than like a 20-bar exponential moving average.
Okay. So it's really based on price.
Which is based on price.
Yep.
Well, I've written a lot of indicators, 20 years ago, 25 years ago. And what I found myself doing is looking at charts and trying to write a mathematical formula to describe what's going on with the chart.
Right.
So all indicators are derived from charts.
Sure.
And over time, what I realized is I'm trying to create an indicator based upon what I'm seeing on the chart and why. I don't need it. If I'm seeing it on the chart already,
right,
I don't need the indicator.
You're getting all the information already.
So now I just look at price action. I just look at movement, and I look for strength of moves. I look at the size of pullbacks.
Right.
And I place my trades accordingly. The stronger a move is, the more I want to trade it like a trend.
Yeah.
The weaker the move is, the more I'm going to be trading it in both directions.
Got it. We were asking about your background a little earlier, and you shared before we started shooting. I'd love for you to share the story about the '87 crash and your experience during that period. Can you tell us what that was like for you?
Yeah. In '87, I started trading several weeks before the crash, and back then, I didn't know. I didn't know what size I should be trading. I just thought, I have a lot of money. I'm an eye surgeon. I own a surgical center, and I traded heavily.
Okay.
And on the morning of the crash, I was heavily short the stock market, S&P futures, full-size S&P futures.
Got it.
And I had to go to work. I had a full schedule of patients to see, so I had to close out my short position.
Right.
And as I was driving to work, I was listening to the news to hear what the stock market was doing.
Sure.
And the news was incredible. They were saying, we don't know what the stock market price is. We just know it's down.
It's down a lot.
It's down. There are no buyers. It's down. It's down.
Right.
And at the end of the day, they decided that the stock market was down about 20 to 25%, depending on which index you use.
Right.
And had I held onto my short positions, I would have made $400,000 on the day.
Right.
Which in today's dollars would have been over $1 million on a day trade.
Right.
And I decided that, maybe there's
something to this.
Yeah.
I usually ask people what a painful lesson from their trading experience. I think I already got your answer, so we don't have to go to that question next. That I feel your pain through that experience. So you mentioned about your general process, about how you look at charts, how you're oriented to price. Can you tell us about the Brooks Trading course? I'm assuming you empower people to use that sort of toolkit. How do you teach that? What you do?
Yeah, I have a series of videos, and I break down price action, movement, to try to show traders predictable patterns.
Okay.
Right. You see the bars to the left on the chart. You want to know what the bars to the right will do.
Sure.
And based upon the price action that's taking place on the left, you can come up with an idea about what the right will be.
Right.
And I'm interested in three things. I'm interested in risk. If you look at a chart and you're looking to buy, you have to figure out where your stop is. That's how much you're risking.
Yep.
You have to look at the profit potential. For example, if you're buying in a trading range, your profit potential is limited. If you're buying in a trend, you have a lot of profit potential.
Got it.
So risk reward, I'm looking at risk reward ratio.
Yep.
And sometimes on television, I'll hear somebody say, this is a great risk reward ratio. I want to take the trade. Well, buying a lottery ticket is a great risk reward ratio, right? So it's
not always the only thing you want to look at then.
There's a third variable, which is really important. It's probability.
Got it. Okay.
So I'm always trying to assess probability. And I always assume at every instant in time, the number of buyers is equal to about the number of sellers.
Yeah.
Okay. Sometimes it might be a little bit more one way or the other. But I'm always assuming that if I'm looking to buy, there's an institution taking the other side, institution looking to sell.
Right.
And they're looking to sell because they can structure a profitable trade shorting while I'm trying to structure a profitable trade buying.
Sure.
So I don't get married to any trade. I don't have any strong opinion. Some people get mad at me. Al, why don't you say the market's definitely going up or the market's definitely going down?
Right.
It's because I can't.
Yeah.
You're operating in a probability band.
Yes.
And the most certain you can ever be is maybe 60%.
Right.
Well, the flip side is the most uncertain you can ever be is 40%.
Right. It might have been, I don't know if it was intentional or unintentional, but when you just described the three pieces, I like how you started with risk before anything else. I feel like a lot of novice investors think about the upside. They think about the return. They think about hitting a home run, but you actually started with risk as the first point to think about. How do you think people should be thinking about risk better than they are? How do you equip people to understand the risk side, which arguably is, in a lot of ways more important?
Well, when I'm talking to traders about trading, one of the things I always tell them is, they say, Al, how big a position size should I trade? And I always tell them, you should always be trading the I don't care size. Okay.
I like that.
It's really true. Because if you care, you're thinking about money.
Yes.
And you're losing sight of risk, reward, probability, money management.
Yep.
So, I tell a trader, if you're talking about, let's say you can trade 1,000 shares of a stock, right? And I tell the guy, well, then you should trade 100 or 200 shares of the stock.
Yeah.
Because you want to be able to think about how to manage correctly. And if the market is going against you and you have 1,000 shares, you think you can risk a certain amount of dollars.
Right.
But when the market's down at that level and you're actually risking that amount of dollars,
right.
You're going to be doing the wrong thing. If anything, you probably should be thinking about buying more.
Right.
But if you're already at your maximum risk, you're not going to be able to do what you have to do to make a profit.
I love how you answer that. We interviewed Price Headley not too long ago as an options expert, and he said, if you're having trouble sleeping at night about your positions, they're way too big. And that's kind of what you alluded to as well. That's great advice. Yeah. Here we're recording this in early February of 2020. Stocks at or near all-time highs, gold essentially in an uptrend, bond prices rallying. What are you seeing right now? What are your views on where the market is headed here? If you had new capital to employ right now, where would you be putting it right about now?
Well, let me first say bonds. There is a really interesting technical pattern going on in bonds. Over the past 10 years, the bonds have been forming a wedge, and within the wedge, there are smaller wedges.
Sure.
So it's a nested wedge pattern, and that's a pretty reliable top.
Interesting.
Okay. And the bonds have been going up for 20 or 30 years.
Sure.
Okay. And it's like a super tanker. It's not like you're going to go from one direction to another direction instantly.
Slowly changing course.
Yeah,
right?
It'll take many years for the market to transition from a bull trend into a bear trend.
Yep.
And I know everybody on TV is talking about zero interest rates. That's not going to happen in the United States. You cannot have zero interest rates in the United States. The American public won't stand for it.
Yeah.
We're the capitalistic leader of the world, and if the government if you lend the government $1,000, and 10 years from now they give you back $950, if 5% less, that's negative interest. You're not going to accept it.
Yeah.
So that's not going to happen, and that puts a cap on bond prices. So I don't think bond prices can go up much higher from here.
Okay.
And I think at some point in the next few years, they're going to start working lower, interest rates going up.
Okay.
And I expect will last at least 10 or 20 years.
Okay.
Stock market, I think the stock market is particularly interesting. We've been rallying for 10 years, so anyone who's been trading for 10 years will assume we're going to keep going up.
Yeah.
And that's not the way it's going to happen.
Right.
You know, if you were trading back in the 90s, you had a great bull trend, but what happened 2000 for the next 10 years, you're sideways.
That's right.
And if you were trading in the 50s and 60s, the stock market went up very strongly.
Right.
And what happened in the 70s? It was in a trading range for 10 years. We've been going up now for 10 years.
Yep.
So what do you think I believe is going to happen over the next 10 years? I think we're going to be in a trading range.
Got it. Okay.
And when the market's in a trading range, when the stock market's in a trading range, it doesn't have 10% pullbacks. It has 40, 50, 60.
Meaningful pullbacks then. Yeah, right. Okay.
And I think that's what the next 10 years is going to be.
Interesting.
Yeah.
So any specific opportunities, so given that idea that we're going to be in more of a trading range environment, if you wanted to put money in the equity arena, where would you try to put it now then to try and plan for that sort of environment?
For me, what I'm planning on doing is I'm looking for pullbacks.
Okay.
20, 30, 40% pullbacks.
Okay.
And then buying.
Got it.
And I do think we're going to get a 30 or 40% pullback in the next few years.
Got it.
Okay. At a minimum, I think we're going down to 2,300 in the S&P.
Okay.
That's the bottom of the most recent trading range.
Sure.
So we've had a trading range for a couple of years. Normally, when you get a correction, you go down to the bottom of the most recent correction, most recent bull flag.
Sure.
So that's 2,300.
Right.
And to get there from here would be a 30% correction.
It's a big move, right? Yeah.
So at a minimum, I think we're doing that.
Interesting.
The market tried to top out in 2014, 2015.
Okay.
The bottom of that range is 1,800.
Yep.
So if we were to go from 3,400 to 1,800, you're starting to get close to a 50% correction.
Got it.
So I think that's where the market is headed over the next 5 years, 10 years, somewhere. You know, the bottom of the range will be somewhere in the 2,000 area, and the top of the range will be where we are or a little bit higher.
Very interesting take, Al. For those that don't know your work, where can they learn more about what you're doing?
Well, the easiest way is to go to the Brooks Trading Course website.
Okay.
brookstradingcourse.com.
Okay. Easy enough. Al, it was so good to meet you. Thanks for sitting down with us today.
Appreciate it. Thank you.
We're here with Al Brooks from Brooks Trading Course here at the Money Show in Orlando.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.